Warren Buffett's investing principles have earned him the moniker of the world's greatest investor. It's a name that Buffett himself chuckles at, but it's hard to dispute when you're worth $80 billion. He has resisted the temptations associated with investing in the next big thing, and has also used his immense wealth for good by contributing to charities. However, Warren Buffett did not become a billionaire as an investor, and he does not invest in the manner usually depicted in popular media. That may be a bold statement to make, but once you actually understand his accumulating wealth techniques, you'll be able to begin similarly running your own investments. With his uncanny ability to uncover profitable long-term investments, it's understandable most investors would like to know what precisely Buffett looks for in a stock. By keeping Buffett's investment advice in mind, investors can sidestep some of the common traps that damage returns and jeopardize financial gain. With all that said, let's take a look at 10 investing tactics Warren Buffett utilizes. Before you invest in any stock, you should understand what the business does and how it makes money. One of the easiest mistakes to make is getting involved in overly complicated investments. Many investors have spent their entire careers working in no more than a handful of different industries. However, what Warren Buffett recommends strongly is never investing in any business that you cannot understand. Buffett invests in cars, planes, trains, catsup, razors, underwear, jewellery, furniture and boring insurance companies. There's no high flyer among them, certainly not an Apple or a Google, but the staples he does invest in all make money over time. He invests in companies, services and products that people use. His philosophy may have caused him to miss out on Google and Amazon, but it allowed him to avoid the worst of the dot-com bubble back in 2000 and the Bitcoin collapse of last year. Warren Buffett is well known for his love of companies that pay dividends, and Berkshire Hathaway has profited dramatically from the company's payouts to their shareholders, such as Coca-Cola. Dividends come from reliable companies that consistently meet or exceed their goals. Their stock may not make you a lot of money quickly, but their dividends can put your investing on autopilot. In his 2019 shareholder letter, Buffett reported that Berkshire Hathaway's top 10 investments had generated almost $3.8 billion in dividends over the previous year. However, perhaps even more than paying dividends, Buffett values the corporate practice of reinvesting profits into growth. Among these top 10 Berkshire Hathaway companies, the amount of earnings that are retained and reinvested is more than double the size of the wages being paid out as dividends. Buffett famously lives well below his means. He's been known to drive an old, modest car, while at age 28, Buffett bought his first house, which he still lives in, for $31,500. Besides, he also picks up breakfast at a McDonald's drive-thru almost every day. Investors can follow his example by looking for new ways to stretch their dollars. For example, when shopping for life insurance, choose an inexpensive term life policy. Use a free browser extension that will find you the lowest price for anything you're buying online, and download an app that will reward you with free gift cards for watching videos and completing surveys. Warren Buffett also doesn't own a yacht or any other expensive toys, and he's pledged to give away the bulk of his wealth to the Bill and Melinda Gates Foundation. Warren Buffett is often used as an example by the media and financial advisors of why you should buy and hold off, but the portrayal isn't really accurate. He buys for specific reasons, and when those reasons are no longer present, he sells. Known as a value investor, Buffett looks for reasonable prices, sound management, and a competitive advantage. In one of his letters to shareholders, he cited GM, Sears, and IBM as companies that were great but could not stay competitive in their marketplace, and as such, they would have been companies to dump out of a portfolio. Buying a stock and holding it forever is not what the Sage of Omaha does. Of the first 20 companies in which Buffett invested, the only one he still has is Berkshire Hathaway, and that is probably only for its name. Each of the other 19 he no longer owns. Although saying no to complicated businesses and industries is relatively straightforward, much more challenging is to identify high-quality companies. Until Buffett added the first high-quality business that Berkshire Hathaway ever bought, See's Candy, to his portfolio in 1996. He had focused most of his investment efforts on finding undervalued assets that he could buy cheaply. The success of the See's acquisition forever influenced their commitment to buying businesses with a strong reputation and brand recognition. Warren Buffett's investment philosophy has evolved over the last 50 years to focus almost exclusively on buying high-quality companies with promising long-term opportunities to continue growth. Instead of giving in to temptation to buy dividend stock yielding 10%, or snap up shares of a company trading for just 8 times earnings, be sure you're comfortable with the company's business quality. When the University of Nebraska-Omaha hosted the Genius of Warren Buffett seminar in 2011, a student asked what aspect of investing he should be studying in his leisure time. Warren replied, "For most people, the bulk of their income is going to come from earning power in their chosen profession. Therefore, from the standpoint of building wealth, free time is better spent sharpening one's professional skills rather than studying investing." He echoed those sentiments in the CNBC interview when he said that anything you do to improve your own talents and make yourself more valuable would get paid off in terms of appropriate real purchasing power. Besides, unlike other assets and investments, nobody can tax it away, they can't steal it from you. In his letter to shareholders, Buffett cites his own experience with Berkshire shares as the most potent argument that he can muster against ever using borrowed money to own stocks. When Buffett took over Berkshire in 1964, the stock was valued at about $19. Its opening price on February 26th was $311,240, meaning that each dollar invested in 1964 would now be worth a mind-boggling $16,381.05. Buffett states that it's crazy to borrow money and risk what you have and need for something that you don't really need. Your strategies will be too closely tied to your need to repay the money if you borrow to invest. Some investments require a long-term plan and holding out for growth, which is a rather difficult task with debt hanging over your head. You don't need much money to invest if you use a popular stock trading app that will allow you to buy fractions of shares for as little as $1, plus you never pay any commission. Phil Fisher said that the stock market is filled with individuals who know the price of everything but the value of nothing. There can be periods in the market where stock prices have zero correlation with the longer-term outlook. Stock prices will swing with investors' emotions, but that does not mean a company's future cash flow stream has changed. While there is always some debate surrounding a company's future earnings stream, the margin of disagreement is usually far lower than the price of volatility. As long-term investors, we need to heed Warren Buffett's investment advice to buy quality when it's marked down in price, since according to him, price is what you pay and value is what you get. He also added, "During the extraordinary financial panic that occurred in late 2008, I never gave a thought to selling my farm or New York real estate, even though a severe recession was brewing, and if I'd owned 100% of a solid business with good long-term prospects, it would have been foolish for me to even consider dumping it. So why would I have sold my stock that was small participations in wonderful businesses? True, any one of them might eventually disappoint, but as a group, they were certain to do well." Another key to ensuring security is to always keep cash reserves on hand. Keep enough cash in reserve so you can buy opportunities that are too good to pass up. At the same time, your money will provide you with a cushion against any unexpected events. This will help prevent you from becoming a panic seller. Buffett says that they always maintain at least $20 billion in cash equivalents. He credits these reserves with helping Berkshire Hathaway stay afloat during the Great Recession, even as so many other businesses floundered. In one of his latest deals, Buffett used all cash as he didn't need to liquidate any investment. By having cash on the sidelines, he was able to pull the trigger with lightning speed. Throughout his shareholder letters and occasional interviews, Warren Buffett has emphasized the importance of investing in trustworthy, competent management teams. When it comes to selecting his business partners and managers, he is cautious since their actions can make or break an investment for many years to come. While other smaller investments lack the resources to evaluate a public company's CEO's character and skill for investment purposes, they can undoubtedly control who they listen to when it comes to selecting their investments and managing their portfolios. The financial world is filled with many good and evil characters. Unfortunately, several people realize they can prey on investors' unrealistic expectations and feelings of fear and greed to make a quick buck. According to Buffett, Wall Street is the only place that people ride to in a Rolls Royce to get advice from those who take the subway. That's it for our top 10 investing tactics Warren Buffett utilizes. Let us know down below if you knew any of them, or any that we might have missed out. Comment any suggestions of videos that you'd like to see in the future. Leave us a like if you liked the video, and think about subscribing if you want to keep up to date with our latest content. But that's it for this video, and we'll see you in the next one.